Tax and legal considerations for VRBO rentals. Whether you are considering using your primary residence or a vacation home that you own as a VRBO or similar rental process, or you have already rented out your property, it is important that you familiarize yourself with tax and legal considerations relevant to such a VRBO rental. Permissibility, zoning laws and homeowners association restrictions. Before listing a property on VRBO, the most immediate hurdle is determining whether short-term rentals are legally permitted in your specific location. Municipalities across the United States have increasingly strict zoning ordinances that may classify rentals under 30 days as commercial businesses, which are often prohibited in purely residential zones. Furthermore, if your property is part of a common interest community, you must rigorously review the homeowners association covenants, conditions, and restrictions. Many homeowners associations have specific clauses that ban short-term leasing entirely or impose minimum lease durations to prevent transient occupancy. Ignoring these local statutes or community bylaws can result in significant fines, cease and desist orders, or liens against the property. Licensing, permits, and occupancy taxes. Once you have established that a short-term rental is permissible, you will likely need to navigate a bureaucratic layer of business licensing and permits. Most cities require hosts to obtain a general business license and a specific short-term rental permit, which often involves a safety inspection to verify fire extinguishers, smoke detectors, and egress windows. Additionally, you must register to collect and remit transient occupancy taxes or lodging taxes, which are distinct from standard income taxes and are levied by the city or county on the rental amount. While platforms like VRBO often collect and remit these taxes for you in many jurisdictions, the ultimate legal liability for ensuring these taxes are paid rests with the property owner. Failure to comply with these registration and tax requirements is one of the most common legal pitfalls for new hosts. The Augusta Rule, tax-free rental income. From a federal tax perspective, one of the most unique provisions for homeowners is Internal Revenue Code Section 280A(g), commonly known as the Augusta Rule. If you rent out your primary residence or vacation home for 14 days or fewer during the tax year, the IRS allows you to pocket that rental income entirely tax-free, without needing to report it on your return. This strategy is particularly popular for homeowners who live near major event venues, such as the Super Bowl or Masters Tournament, allowing them to capitalize on peak demand without administrative burden. However, the trade-off is that you cannot claim any rental expense deductions for those 14 days, effectively treating the income as a non-event for tax purposes. It is a strictly all-or-nothing rule that ceases to apply the moment you rent the property for a 15th day. Determining tax status, personal versus rental property. If your rental activity exceeds 14 days, the IRS requires you to classify the property as either a personal residence or a rental property based on your personal usage. Under the mixed-use rules, if you use the home personally for more than 14 days or 10% of the total rental days, whichever is greater, the home is considered a residence, and your deductible expenses are capped at the amount of your rental income. Conversely, if you limit your personal use to below these thresholds, the property is viewed as a business activity, potentially allowing you to deduct losses against other passive income. Accurate tracking of every single day of personal use versus rental use is critical, as failing the usage test can significantly alter your financial outcome. Reporting income and allocating expenses. For properties rented more than 14 days, you must report all rental income on IRS Schedule E, but you also gain the ability to deduct significant operating expenses. These deductions include mortgage interest, property taxes, insurance, cleaning fees, platform service fees, and utilities, though they must often be prorated based on the ratio of rental days to total usage days. For example, if you rent the house for 90 days and use it personally for 10 days, you generally allocate 90% of your expenses to the rental business. It is vital to keep distinct records and separate bank accounts for the rental activity to substantiate these expenses in the event of an audit. This separation of finances also serves as a professional foundation for treating the rental as a legitimate business enterprise. Depreciation and recapture implications. One of the most powerful tax shields for a rental property is depreciation, which allows you to deduct the cost of the building, excluding land, over a recovery period of 27.5 years. This non-cash deduction can substantially lower your taxable rental income, often making the property appear less profitable on paper while it generates positive cash flow. However, owners must be aware of depreciation recapture, a tax provision that kicks in when you eventually sell the property. Upon sale, the IRS effectively claws back the taxes you saved via depreciation by taxing that amount at a designated rate, currently up to 25%, which can lead to a surprisingly high tax bill at closing. Understanding this long-term tax liability is essential for calculating the true return on investment for a vacation rental. Liability protection and insurance gaps. Finally, reliance on standard homeowners insurance is legally risky because standard policies almost always exclude business activities, including short-term rentals. To protect your assets, you must obtain a commercial liability policy or a specialized landlord insurance rider that explicitly covers short-term rental activities and guest injuries. Furthermore, many property owners choose to hold the property within a limited liability company, LLC, rather than in their personal name. This legal structure creates a barrier that protects your personal savings and primary residence from lawsuits that might arise if a guest is injured on the rental property. Without this corporate veil and proper commercial insurance, a single accident could jeopardize your entire personal financial portfolio. To learn more about our law firm's international legal practice, we welcome you to visit our website or contact our law firm to schedule a confidential consultation. Thank you.